Welcome back to Investing Talk Podcast.
Good to be back.
We've got a really interesting one today. We are focusing on Recursion Pharmaceuticals,
Right.
a company that's really at the absolute cutting edge of AI-driven drug discovery. But it also, demonstrates that high-stakes financial tension that comes with this kind of innovation.
Absolutely. This stock has been, well, let's just say volatile.
That's putting it mildly. It's not just trading on news. It feels like it's trading on pure expectation versus, well, pure fear sometimes.
Yeah, it's a fascinating case study. When you look at Recursion, you're kind of looking at a proxy for the whole AI and biotech convergence, aren't you?
That's a great way to put it.
So our mission today really is to break down the bullish case and the bearish case surrounding Recursion.
And get to that core question everyone's asking. Is this stock a good time to buy now?
Exactly. We need to unpack the financial risks, definitely look at the technological advantage they claim to have, and crucially, those near-term catalysts.
Okay, so we'll structure this around those key areas. The risks, the tech moat, the catalysts.
That's good.
Now, before we really get into the weeds, just a quick reminder, we encourage you to subscribe, like, and comment below.
Yeah, definitely let us know what you think.
And also, if there's a specific company you'd like us to look into, please leave a comment. We do read those.
We do. Okay, where should we start? The fear.
Let's start with the fear side. I think it makes sense because it's been such a powerful factor recently. Over the last 3 months, the volatility, as we said, it's been extreme. We saw that significant stock decline. What was it, October 7th? A drop of minus 4.6%.
Yeah, that was tied to mixed reactions on the financials.
Right. But what really seemed to spook investors wasn't just the market noise. It felt more specific. It was the insiders.
That's right. A big part of the bearish feeling was definitely driven by insider activity. Specifically, insider trading concerns popped up back in July and August.
Right.
We saw some pretty substantial sales by key executives, Christopher Gibson, the CEO, and Najat Khan, the chief scientific officer.
And I always find insider sales need a closer look. I mean, when the people actually running the company are selling off millions of dollars in shares, and you don't see any significant insider buys to balance that out, it just immediately raises skepticism, doesn't it?
It does. It sends a pretty strong signal. You start asking, okay, what do they know that maybe the market doesn't fully appreciate yet about, say, the difficulty of scaling this tech?
Exactly. Do they see hurdles we can't?
And when you combine that selling trend with the, frankly, distressing profitability numbers.
Yeah, let's talk about those.
The negative margins, the really substantial operating losses that came out in their financial statements. It paints a picture.
A picture of struggle, financially at least.
It really does. And it helps explain why some analysts, like Morgan Stanley, took a very cautious view, setting that conservative price target of, what, $5?
Right, $5. So that sets a pretty clear baseline for the pessimistic argument. Insiders selling, big losses.
A tough combo.
So, okay, executives selling, losses piling up. But the stock isn't zero. There's obviously another side to this.
There absolutely is.
The reason it survives, I suppose, is this story of incredible, albeit very expensive, growth.
Let's pivot to the fundamentals then.
Yeah, let's get into that, because this is where that profitability paradox really hits you.
It really does. So despite all the worry about the losses, the revenue growth, you have to admit, remains robust.
Okay.
The trailing 12-month revenue, the TTM figure, as of October 2025, hit $64.60 million.
$64.6 million. Okay.
And even more impressively, maybe, the full year 2024 revenue was $58.84 million. Now, that reflects a huge 32% year-over-year increase from 2023.
Wow, 32%.
Yeah, and that's considerably outpacing many of its niche biotech peers.
So where is that growth coming from? Is it sustainable?
Well, a lot of it's fueled by anticipated milestone payments from their big pharma partnerships.
Ah, the collaborations.
Exactly. And analysts project those payments will actually accelerate through 2026 as the clinical pipeline moves forward.
Okay, that sounds great on the surface. Real market validation from big players paying milestones.
But, and this is the huge but, the profitability paradox. To achieve that growth, to build out that proprietary platform, they're just burning through cash.
Yeah.
Deeply unprofitable.
How bad is it?
The company reported a TTM net loss of $649.13 million.
Wait, $649 million on $64 million in revenue?
Precisely. And that translates to an earnings per share, or EPS, of negative $1.80.
Okay, wow. That's That's not just R&D spend. That's an astronomical amount relative to revenue. That's
And
scaling costs, right?
it's everything. Heavy R&D, yes, but also scaling up operations, the platform itself.
So to put that in perspective for you listening,
Yeah.
the pure cash outflow, the negative free cash flow, the estimate for 2025 alone is an outflow of $361 million.
$361 million.
They are burning through nearly $1 million a day just to keep the lights on and the AI crunching data.
A staggering number.
So how comfortable can anyone be that they won't just have to dilute shareholders again, raise more money before they ever get close to profitability?
Well, that cash burn is the elephant in the room, no question.
Okay.
And this is where we have to connect that massive outflow to the company's financial resilience, or lack thereof, depending on your view.
Is there a safety net?
There is. The saving grace, for now anyway, is their strong balance sheet. The company maintains an estimated $533 million in cash and equivalents.
Okay, $500 million. That's substantial.
It is. And it provides a pretty strong funding runway given the burn rate.
Right, so doing the math, $533 million cash, burning $361 million this year. How long does that last?
Well, the estimates, based on the sources, suggest that runway lasts through at least the fourth quarter of 2027.
Okay, Q4 2027. So they've bought themselves time. Couple of years, roughly.
They have. And that financial buffer, combined with the fact that the balance sheet shows no material debt, they give them immense flexibility, strategically speaking.
No debt is definitely a plus in this environment.
Huge plus. But, and here's the critical distinction again, the market sees they have time to execute. But that execution time is defined by the cash runway, not by actually reaching profitability.
Right, so when do they expect to actually make money? Or at least stop losing it so fast?
That's the multi-million-dollar question, isn't it? The definitive shift to positive free cash generation, actually bringing cash in. That projected $139 million FCF.
Yeah.
That isn't anticipated until 2029.
29. Oh, wait, so the cash runs out end of 2027, but positive cash flow isn't until 2029.
Exactly. There's a significant operational gap there, almost 2 years, potentially, between when the current cash pile might run dry and when the projections show them generating cash.
Okay, that's a major hurdle they need to clear. They'll likely need more funding or significantly beat expectations before then.
Or achieve some major milestones that trigger big payments. It highlights the risk.
Right. But that substantial cash runway, even with the gap, it allows us to talk about why anyone is tolerating these losses. The optimism isn't financial, it's purely technological, right? It's that proprietary AI-driven drug discovery platform.
That's the hope side of the coin. Absolutely. We move from scary finance to potentially groundbreaking science.
So tell us about that. Why is it special?
Well, Recursion is genuinely a pioneer in this space, AI-driven drug discovery. They haven't just built a piece of software. They're trying to industrialize the whole process of finding new therapies.
Industrialize it. Okay.
And their competitive moat, what protects them from rivals, it seems pretty substantial. It's protected by both the complexity of the tech itself and the sheer scale of their data.
Okay, the data. The sources mention these proprietary phenomic data sets, totaling over 65 petabytes.
Yeah, 65 petabytes.
That number sounds enormous, but it's abstract. What is that data, actually? Is it gene sequences, chemical structures, what?
It's massive, yes, but it's quite specific. Think of it as literally billions upon billions of high-resolution images of diseased human cells.
Cell images.
Yes. And crucially, those cells have been treated with thousands upon thousands of different molecules and compounds. The AI platform, the Recursion OS 2.0, it's not just crunching numbers in a spreadsheet.
It's looking at pictures.
It's looking at the visual patterns, the phenotypes of the cells, how they change in response to compounds. It's searching for these hidden biological connections, subtle visual cues that, frankly, no human eye or standard lab screen could ever hope to catch systematically.
So the tech is basically pattern recognition on cell images to predict which molecules might work against a disease, way faster than old school methods.
That's the core idea. Finding effective needles in vastly larger haystacks, much faster. It has the potential to be a true paradigm shift in drug discovery.
And the merger with Exscientia helped here.
Oh, absolutely. That was crucial. It bolstered the platform significantly, integrating biology, chemistry, and even clinical analytics into one sort of unique, streamlined system.
Okay.
This whole data engine enables target discovery and optimization cycles that are potentially far faster than the industry norms. That's the technological edge investors are betting that $500 million of cash on.
And presumably the big pharma partnerships help validate this.
Yes, and they provide that revenue stream. The business model leverages recurring revenues from collaborations, plus those milestone payments we talked about, with established players.
Right.
That third-party validation and the financial structure it creates, that builds pretty high barriers to entry for would-be competitors. It's meant to be a sustainable growth driver, built around being first, providing cash to fuel that R&D burn.
Okay, so a potential technological moat, validated by partners, but still burning tons of cash. Let's turn to the technical side now. What are the charts telling us? Because despite the earlier gloom, the hope narrative seems to have gained traction lately.
It definitely has. We've seen a pretty aggressive rebound recently. What was it, up almost 18% in October alone?
Yeah, 17.9%. And up again recently, 3.85% on October 13th.
That recent momentum is quite key from a technical perspective. The stock is now trading above both its 50-day and its 200-day moving averages.
Which technicians love to see.
They do. It's often seen as confirmation of a renewed uptrend, at least on the charts.
But where is it now relative to its highs? Still got room to run?
Oh, definitely.
Right.
While the current price, around $6.17, is looking healthier technically, it's still miles below the 52-week high of $12.36.
Okay, so potential upside if the story holds.
Potential, yes. The technical picture looks much better than it did, say, back when those insider sales were really dominating the headlines.
So what are the key levels traders are watching right now? Support and resistance.
Looks like support is pretty solid, down around the $5 to $5.25 zone. That seems to be a floor for now.
Okay.
And resistance, the level it needs to break through, maybe on good news, that's looming right ahead, around $6.57.
$6.50 to 7. Got it. What about analysts? Are they buying into this rebound?
Well, they certainly see potential upside from here. The consensus price target among analysts is around $7.25.
$7.25, so above that near-term resistance.
Exactly. And some high-end targets go up to $10.
$10. Okay, that suggests pretty significant belief in that tech edge paying off eventually.
It does. But of course, that upside is highly dependent on upcoming catalysts hitting successfully. Things need to go right.
Which brings us to catalysts. What are the big events we need to track, say, in the next 3 months? For anyone trading this, these are crucial.
Okay, immediate focus is on financial events. We've got the Q3 earnings report coming up soon.
Yeah.
Late October or maybe early November.
Right, and then the Q4 preview.
Q4 earnings preview is slated for December 15th. Obviously, negative surprises there could hit the stock hard, but positive guidance could really fuel this rally.
Makes sense. What else?
Well, there's an institutional investor meeting scheduled for November 20th. That's always important for gauging interest from the big money. A good indicator of long-term belief.
And any market mechanics stuff.
Yeah, minor point maybe, but ETF rebalancing on October 28th, that can sometimes cause short-term fluctuations depending on index inclusions or weightings.
Okay, but the really big ones, the potential game changers, those must be pipeline updates, right? Clinical trial data.
Absolutely. Those are the events that truly test the power of the AI platform itself.
Which drugs should we be watching?
We're keeping a close eye on anticipated clinical trial readouts for key programs like REC994, REC2282, and REC4881.
Okay, give us some context, like REC994. Why is that one critical? What's it for?
So REC994 is targeting a rare vascular disorder. It's called cerebral cavernous malformation.
Okay.
Positive data here wouldn't just be progress on one specific drug candidate. It would serve as major validation for the entire Recursion discovery platform.
Ah, the proof of concept.
Exactly. It would show the AI isn't just finding interesting connections in a computer, but that those insights can translate into potentially viable drugs for actual patients.
Yeah.
Especially in these niche, difficult disease areas.
So if they get good efficacy and safety data there.
That's the ultimate proof point the market's been waiting for. It would likely cause a significant, pretty immediate boost. Could easily push the stock past that $7 resistance level we mentioned.
Big potential catalyst then.
Huge.
And I suppose we can't forget the more speculative stuff either, right? Rumors, whispers.
Always a factor with these kinds of stocks. Rumors of maybe a new major partnership with a big pharma company or maybe some announced breakthrough in the AI platform itself. Those things could cause a spontaneous jump too.
High risk, high reward possibilities just hovering there.
That's the nature of the beast with developmental stage biotech, especially one leaning so heavily on novel tech. The investment thesis really hinges entirely on capturing that long-term secular growth in AI meeting biology. It's classic risk-reward.
Okay, so let's try to bring this all together for you, the listener. The overall outlook here seems to hinge on balancing that extreme optimism about the innovative tech
Yeah, the AI platform, the big data sets.
Right, and also the fact they do have that large cash reserve. Balancing all that against the very real concerns over the immediate financial performance.
Especially that severe cash burn we talked about.
Yeah.
And those, somewhat concerning insider sales from earlier in the year.
So the source material we looked at, it actually suggests an overall bullish rating, right? An 8 out of 10.
It did, yeah.
Yeah.
Which makes it seem attractive, potentially, for both short-term trading, maybe playing those Q4 catalysts, and also for longer-term investment, trying to capture that whole AI biology growth trend.
Yeah.
But high-risk tolerance is absolutely essential here.
Yeah, this stock clearly isn't for the faint of heart. You need conviction in the tech and patience.
Definitely.
So maybe the essential takeaway, the final thought for you to ponder is this. The company has cash runway, we think, until Q4 2027. That gives them time to execute.
Right. A window.
But their own definitive projection for actually hitting positive free cash flow isn't until 2029.
2 years later.
Given that key executives sold millions of dollars worth of shares now, not waiting for 2029, how much faith should you, as an investor, put into the long-term potential of that AI platform, bridging that crucial multi-year execution gap?
That's the question to wrestle with. How much do you bet on the tech overcoming the financial realities and that timing mismatch?
Something to think about as you analyze your own strategy.